Buying call options. Should you buy options in order to make money? David Jaffe with BestStockStrategy.com, and in this video we are going to discuss buying options. So usually I like to sell options. The only time that I will buy options is as a hedge to protect against volatility expansion during volatile markets, or actually if volatility is really low, and I will trade spreads by selling them in order to protect against a large volatility expansion event. A lot of people believe that it's best to buy options, primarily if they have a bullish thesis on the underlying stock. Then they'll believe that it's best to buy call options because you can buy a call option for about $1 or $2 and then sell it for $10 or $12. The problem with this is that it is a low probability event that is going to make money probably around 20 or 30% of the time. Now, the magnitude of the wins can sometimes override the probability of profit, meaning that if you make 10 times the amount of money on 20 or 30% of your trades, then that will offset all the losers. A good example of this would be Tesla. I believe it was January 7th and 8th of 2021 when Tesla went up about 18 or 19% in those 2 days. So if you had bought call options, then you would have made a lot of money on that. However, the issue that I have with call options is that I believe it is similar to gambling. Do people make money by buying options? Yes, they do. Do people make money consistently by buying options? No, I don't believe that they do. And the primary reason is that the actual volatility is oftentimes always less than the expected volatility, which means that when you buy options, it is similar to someone buying insurance from an insurance company and expecting to make money from it. If you buy car insurance, it's pretty rare that you're actually going to get into a car accident and make money from it. Does it happen? Yes, it does. However, it is exceedingly rare because the insurance company is not in the business of paying out claims and losing money. It's a similar concept when you buy options, even though it's a much more liquid marketplace. It is definitely possible, if you are very bullish, to buy call options and you know that it's a defined risk trade because the maximum amount that you can lose is just the premium that you paid for the option. However, at the same time, you have to be pretty careful because the probability of profit on that position is very low. And like I said earlier, the primary reason is that you are overpaying for expected volatility because the expected volatility almost always exceeds the actual volatility. So what do I like to do instead? I like to sell options. The problem with selling options is that you're really only hitting singles. You're not going to hit home runs because your maximum profit is going to be the premium that you collect. So instead of earning 10 or 20 times your money like you would when you buy options, but winning a very small percentage of the time, instead you're going to win a large percentage of your trades when you sell options, but you're going to make a little bit of money with each profitable trade that you make. So for example, if Amazon right now is trading at around $3,100, you can sell a put option which would enable you to buy Amazon at the strike price. So if you sell a put option on Amazon with a strike price of $2,600, then you will be forced to buy Amazon at $2,600 if Amazon falls below that price. Now, you'll also be paid, let's say, around $7 or $8 for making that trade and for agreeing to buy Amazon at $2,600, depending upon your expiration date. However, the problem arises where if the market crashes and Amazon falls to $2,300, then you're still going to have to buy Amazon at $2,600, which means that the difference between your strike price at $2,600, which is where you're going to buy it at, and the current market price, which would be $2,300 in our example, would be $300, in which case your loss would be the difference between what you paid for the stock, which is $2,600, and the hypothetical current market price of the stock, which would be $2,300 in our example, less the amount of premium that you received. So in our hypothetical example, which maybe it happens like 1/10 of 1%, you would have to pay $300 more for Amazon than it's currently trading at. So in that example, you are risking a lot of money in order to make a little bit of money, but you're also going to win more than 95% of your trades. So how do successful options traders limit this tail risk and worst case scenario? The best way to do it is actually to buy options and to trade vertical credit spreads. So instead of selling the $2,600 put on Amazon as a naked put option, you can instead sell the $2,600 and buy the $2,500, and then your maximum loss will be the $100, which is the width of the strikes. So you would agree to buy it at 25, but then if Amazon fell to 23, you can put it to someone else at 25. Therefore, you're turning that undefined risk trade, which would theoretically give you $2,600 worth of risk if Amazon went bankrupt. And instead, by buying that $2,500 call option, you are instead defining your risk to the width of the strikes, which is $100, less the amount of credit received. So this is a very simple explanation of how selling option premium works. Do buying options work? Yeah, it definitely does. There are some people who make money. I know that John Carter with Simpler Trading made a lot of money on his Tesla position, but in my opinion, something like that happens like 0.5% of the time or 1% of the time. So if you have a little bit of money, then I guess it's okay for you to buy options and just try to hit a home run. And it's almost like buying lottery tickets. But there are other ways of structuring a transaction where you can actually finance buying an option with selling an option so that you do have the upside potential. So for example, if you were very bullish on Amazon and you also wanted to reduce your risk, and let's say Amazon is currently trading at $3,100, you can sell the $2,700 and you can buy the $2,600 strike. So then you would have a vertical credit spread of $2,700 by $2,600. You would collect premium, probably around $8 to $10 for doing that. Then you can use some of that premium that you collected, and you can use that premium to buy a call option that's out of the money, let's say with a strike price of $3,350. And that would probably cost you around $6 or $7. And therefore, on a net basis, you would have a very bullish position on Amazon where you actually got paid because selling the vertical credit spread would bring in more money than buying that call option. David Jaffe with BestStockStrategy.com. You can go to BestStockStrategy.com, enter in your email address, and receive over $400 worth of valuable free training. Please leave your comments below and let me know your thoughts on whether you believe buying call options is worthwhile. Let me know whether you have had positive experiences with buying call options, and I appreciate your attention.